In recent years, the returns on risk-free investments have hit record lows. But we think that there are ways to find more attractive returns. One such solution is a fixed maturity bond fund, which can help you boost your returns while also diversifying your investments. A fixed maturity bond fund is a portfolio of bonds with the same maturity date. A bond is a debt instrument that can be issued by governments, public sector bodies, or companies to finance their projects. In exchange, the issuer makes a commitment to pay coupons or interest on a regular basis and to repay the capital at maturity. The closer the fund gets to maturity, the weaker the impact of a move in interest rates. This is a significant advantage in the current environment of rising interest rates, as a bond's price falls when its yield rises. Moreover, the risk of an issuer being unable to repay its debt diminishes as the fund approaches maturity. In addition, to limit this risk, the investment team diversifies the portfolio by selecting investments in different regions and sectors, rather than putting all of its eggs in the same basket. Nonetheless, as the maturity date approaches, a risk of concentration in a particular bond may arise. The investment team does not confine its work to building the portfolio and waiting for the maturity date. It carries out in-depth analysis of the securities owned and of the bond markets on a regular basis. If the investment team believes that the health of an issuer has deteriorated sufficiently to jeopardize that issuer's capacity to redeem the bonds, it may sell them and seek new opportunities instead. However, as with any investment, the outcome cannot be guaranteed, and this investment entails a risk of a loss of capital. This active management approach may also prove useful in the event of the early redemption of a bond in the portfolio, as in before its maturity date. The proceeds can be reinvested in bonds with a shorter maturity or in money market instruments. It goes without saying that investments must be selected carefully. It is also essential to diversify the positions in the portfolio in order to limit the impact a potential default could have on overall performance. This is where the expertise of the investment team comes into play. Its deep knowledge of issuers is a key success factor. In short, in exchange for the risk assumed by investing in international bond markets, a fixed maturity fund offers a defined investment period, decreasing sensitivity to changes in interest rate, and the ability to diversify and actively manage investments. All of these advantages mean that a fixed maturity fund could be a good solution in the search for yields. Contact your advisor today for an assessment of your situation and diversify your investments with a fixed maturity fund.